Hey guys, welcome back to Explore. Today we'll talk about Kinder Morgan versus ChargePoint. Let's head into it. Kinder Morgan versus ChargePoint. ChargePoint, nice CHPT, an electric vehicle, EV, charging station network, and Kinder Morgan, nice KMI, a pipeline giant, appear to have little in common on the surface. However, both energy stocks are helping to shape the economy of the future. The majority of traditional automakers have revealed either a completely new electric vehicle lineup or an electric version of an existing model. No matter who wins, new electric vehicles will require charging stations. This is where ChargePoint enters the picture. It is placing a large bet on the rise of at-home and public charging instead of gas stations. It has partnered with business to establish charging stations in shopping malls, business parks, and other locations. Meanwhile, Kinder Morgan believes that natural gas and other fuel transportation and storage will continue to play an important part in the United States energy balance, as well as an export commodity to delivering countries. Here's a comparison of the two firms to help you figure out which is the better bargain. Also, make sure to write your thoughts in the comments section. ChargePoint. ChargePoint is a major player in the race to develop North America's electric vehicle charging infrastructure, a connected network of public charging stations. Similar to the necessity for petrol stations, is expected to facilitate more EV adoption. While the future looks bright for charging providers, it's no secret that the epidemic outbreak halted new electric vehicle sales. According to S&P Global Research, electric vehicle sales in the United States in 2020 will be down roughly 10% from a record high of 331,000 in 2019. To put things in perspective, total vehicle sales in the United States in 2019 were roughly 17.2 million, making electric car sales little under 2% of total sales. Given that EV adoption in North America is still in its early stages, it's not unexpected that there are few publicly traded EV charging companies based in the United States. For various reasons, ChargePoint appears to be the best of the bunch. Level 2 charging stations, which provide 240 volt AC electricity at a rate of roughly 25 miles per hour, are already well understood by the corporation. It's not much, but it gets the job done when a car is parked for a prolonged period of time. Over 132,000 charging stations are available through ChargePoint, the vast majority of which are level 2. In addition, the company is expanding its range of quicker DC charging alternatives, including its own take on the Tesla supercharger, trucks, buses, delivery vans, and even semi-trucks, which are increasingly looking at electric possibilities, have a lot of room for growth. ChargePoint expects to generate roughly $200 million in revenue in fiscal year 2022, giving it a forward price to sales P/V ratio of roughly 37. ChargePoint provides investors with an entry into what might be a paradigm-shifting market. While it is not inexpensive by traditional value standards, Kinder Morgan is the pipeline infrastructure leader in North America. Although the corporation primarily transports natural gas, it also deals with a number of other petroleum goods and chemicals. Kinder Morgan is a very different investment than, say, ChargePoint, which is an unprofitable growth stock. While ChargePoint is increasing its investment and expanding into new areas, Kinder Morgan is lowering costs and strengthening its balance sheet. The company has done a good job of generating buckets of operating cash flow, which has aided in debt reduction and dividend growth. The chart above depicts a textbook example of a reliable dividend stock. The problem with Kinder Morgan, on the other hand, is that its lack of expenditures could stymie its long-term expansion. Kinder Morgan is susceptible if the world of tomorrow relies less on fossil fuels. Much as ChargePoint plays in the narrative of rising EV usage, Kinder Morgan's largest risk is that natural gas usage, whether industrial or residential, stagnates or drops in the coming decades, causing profit margins to contract and the company to lose value. Kinder Morgan's prudence and capital discipline should be applauded by investors concerned about this threat. Kinder Morgan's dividend yield of 5.9% is more than 3 times that of S&P 500, which helps to mitigate industry risks. stocks. The verdict. ChargePoint has been in operation for nearly 15 years, cementing its position as the global leader in a new industry. Meanwhile, after the oil and gas meltdown of 2014 and 2015, Kinder Morgan disappointed investors, only to rebuild with a safer business model that is better for dividend investors. The regular earnings and accurate forecasts provided by Kinder Morgan give the amount of consistency that income investors seek. ChargePoint's guidance, on the other hand, might fluctuate wildly based on a myriad of events beyond its control. Due to its lack of investing, Kinder Morgan is unlikely to develop at the same rate as ChargePoint, let alone its competitors. The irony is that it isn't even attempting. Kinder Morgan is a great option for seniors wishing to supplement their income or any investor looking for a reliable dividend return. ChargePoint, on the other hand, is a high-risk, high-reward growth opportunity. Kinder Morgan is likely to be the better investment for most investors. ChargePoint, on the other hand, could be well worth the risks for those with a long-term time horizon, saintly patience, and a stomach designed to tolerate volatility. What do you think about Kinder Morgan and ChargePoint? Which one is the better stock to buy? Let us know in the comments section. This brings us to the end of our video. I hope you enjoyed it. Hit like if you did, and don't forget to subscribe to our channel so you don't miss any of our videos in the future. Also, watch the 2 videos that are on your screen because I am sure you'll love them. With that, I'll see you in the next video. Bye guys.